Hi folks, it's Dr. Jeff Camarda. The word from Jeff, executive summary at our markets update here in October. My goodness, what an October it's been so far. And actually I wrote this just a week before this great plunge had begun. Hopefully it settles down soon, but after a great 2017, clearly investment markets have become quite unstable, especially now later in 2018, mostly we think over global trade disruptions. Many U.S. and foreign asset classes got hit and continue to get hit. We do expect recovery as the world order adapts and normalizes, though this may take some time. The U.S. is in a position to dictate trade terms, better trade terms at least, and clearly is muscling to get what it wants. We expect trade to normalize in 2019. U.S. stocks, even after the recent plunge, are by many measures overvalued and due for a correction or bear market. Again, I wrote this before this plunge began. I think we're probably in the middle of the early phases of it. Because the U.S. economy, though, is so strong, this may not fully present itself for quite a while. Still, U.S. stock investors should focus, we think, increasingly on value, buying quality companies that are out of favor and relatively cheap. It gives you more of a cushion. If things tumble and if they're already inexpensive, there's less air to come out of the balloon. They should hold up a lot better, or actually even go up, even while other markets go down. Foreign markets still, for the most part, are very, very cheap and represent great value. While it will take patience to capture this value, we think the next leg up for investors from 2019 to the early 2020s will be in non-U.S. stocks. Again, the U.S. economy is on a tear and will keep soaring, we think, on the wings of tax cuts, infrastructure spending, and still very low by historical standards, but rising interest rate costs. Cracks are appearing, though, and a recession is inevitable at some point. We do expect a slowdown as interest rates normalize in the 5% range, probably in 2020 or 2021. So the investment strategy summary for us, number one, U.S. stocks should be in a value posture. For the U.S. versus U.S. stock allocations, we want to be looking at companies that are cheap compared to their earning power and the underlying value of the assets. Number two, non-U.S. stocks deserve significant allocations. Number three, yields are becoming attractive. We've been out of bonds for years, as most of you know, and we continue to have an aversion to bonds. We think they'll continue to drop for a couple of years yet, but mid and longer term bonds should be avoided until rates climb higher. We are starting to wade back into shorter maturity bonds, though, in order to pick up a little bit of yield. And hopefully that was helpful and somewhat calming. Until next time, this is, and over the coming weeks, by the way, you'll get deeper thinking on each of the principles that result in this conclusion and summary you just heard, and hopefully you enjoy those. If you need us, jay@camarda.com or 904-278-1177. Thanks for watching. Until next time, this is Dr. Jeff Camarda.